It is that time of the week. We sit down and talk to our man, Zach Abraham, Chief Investment Officer, Bulwark Capital. We talk about, the markets, the economy, and everything. Okay, let's jump at it. Everybody thought 25 basis points. We kind of got what we got, right? Like that was already kind of baked into so much, right? No surprise.
None. I always laugh every time a Fed decision comes down the pipe because everybody, you listen to the media, and it's probably just because the 24-hour news cycle, right? They got to have something to talk about. Or you know what? Actually, people in the media probably don't know this, but if you go back to 2005, so over the last 20 years, and that's all we look back to because the data gets a little spotty after that, but um, every Fed decision since then, only one time, and it happened in 2006, going into weird stuff going on around, right before the financial crisis. Only one time has the Fed not made a move that the market has priced in prior to the meeting. So in 20 years. So for 20 years, every single Fed meeting, whatever the market had priced in prior to the meeting, that was the number. So, if you just look at what the market prices in ahead of time, and the way you can tell that that's not going to be the case is if you get about a week out from the Fed meeting and the Fed governors start coming out one after another talking, and you're just, why are these guys on TV all the time? They're trying to move the market price. They're trying to move because the market's trying to predict, right? So
Yeah.
like for instance, if you have if like 30-day SEC paper, right? 30-day Fed Treasury paper or Fed paper, right? That reverts within 30 days to whatever that Fed funds rate is, right? So what the Fed wants that number. The Fed does not want to make an announcement about monetary policy that the market hasn't priced in. Now, we can have another discussion about whether that's smart on the Fed's part. I think it's bad. I think it makes the market more brittle and less dynamic. But that is their policy nonetheless. So yeah, anytime everybody's like, oh, what's going to happen at the Fed meeting? You're like, well, you got a 99% chance being right if you just go with whatever the market's priced in. So yeah, no surprises there whatsoever.
The market's crazy. The economy, I don't know. I don't think Powell's worried about inflation at this moment in time. I do think he's worried a bit about though jobs and are we getting a slowdown? I think the inflation thing right now isn't his number one, thought process. I think there's a worry about the whole job market. Are we headed to a slowdown? Because that's a scary place for everybody to be at.
Yeah. So now, of course, in this business, you always reserve the right to change your mind and be wrong, because that happens. Unlike a lot of people today, especially any financial people you find on Twitter, I have been wrong before. I've made mistakes. I know how rare that sounds, right? That I'm not all knowing. We have a joke around here, which is we're the only traders on Twitter that have ever made a bad trade.
Yeah.
Just because it's social media, right?
Yeah.
Just well, everybody gets that right.
Everything's beautiful.
Oh yeah. Everybody's Stan Druckenmiller, right? But no, you've got an interesting thing going on in the economy right now, because from our perspective, I think that you've got to pick one or the other. You either have to pick an economic slowdown with sustained higher levels of unemployment, or you have to have above trend inflation. And I could be wrong, but when I'm looking at, and what leads us to believe that is that, and it's possible that it's a short-term impact of tariffs. I don't think that's the case. And record housing and affordability really plays into that. Like because think about it, some of your biggest components into inflation readings are fuel, and housing. Those are two of the biggest.
They always take those out whenever they freaking do any of the CPI. We took everything out that really matters, and now we're going to base it on how much your socks cost last year compared to now.
Yeah, we're gonna use soybeans as a primary way of looking at inflation, right? Something that you could easily avoid. We're gonna price it on all the things that you don't have to buy.
Yeah,
but so if you step back and look at housing still at record in affordability, and you look at oil at 60, if you have any type of economic surge or any type of economic growth impulse, I don't understand how, and now you're starting to cut rates. That's going to push housing prices higher.
Yeah.
That's most likely going to push oil higher. I, so I kind of think you're stuck in this place where, look, we've got to pick and this was the other reason why we think this is happening, Chad, is this was always going to be the end point of extreme monetary policy, meaning you were eventually going to get to a point where you had to pick. Do we take a slowdown or do we accept and live with higher than trend inflation? And our whole point all along has been, we think they're going to do what government has always done, which is go with higher trend inflation because it's easier to explain away and still win an election than it is if you've got breadlines.
Yeah.
Right. So, go back through time. That's what every government does, back to England, Spain, France.
Well, I mean, you just have to say bread lines right there, Zach. I mean, that's a perfect example of, being pissed because stuff costs a little bit more and maybe you can't get everything you want is different than freaking waiting for your unemployment check and worried whether or not you're going to have a job in the next couple months.
Yep. Yeah. So not hard to see why they pick that, right? The thing that's always irritated me is how we get there, right? Because if these things occur after long periods of time of, in my opinion, irresponsible policy and irresponsible managing of the economy. And one of those irresponsible things, in my view, was this idea that we're going to do whatever it takes and be as irresponsible as we want to be to get to these metrics like 3% growth and 2% inflation because the Fed has decided that that's what we need, right? Well, what does that add up to after 15 years? It adds up to 130% debt to GDP, and it adds up to a scenario now where you really don't have the tools to do whatever you want to do on the monetary side, because if you push too hard on the stimulus side, inflation's going to pop right back up, and you're stuck in a corner. You've painted yourselves into a corner here. That's our belief. We'll, like I said, could be wrong. See if it plays out. But when you look at how tight this economy is, think about minimum wage the country over. The difference between minimum wage today than 2019. I bet you're on average about double around the country, right?
Yeah.
So there's never been a time, to my recollection, there's never been a time where minimum wage has increased so much over such a short period of time, right? At the same time, you're exiting immigrants to a large number, which we have to do. The previous administration just opened the doors and let 20 million dance on through, right? But all of these things, none of them are like a silver bullet, but all of them are inflationary. So I don't see housing at record. Now you think you're going to cut rates. I don't understand how that helps out the housing situation. Everybody goes, well, it makes mortgages cheaper. And I go, which makes house prices go up.
Yeah. I mean,
Right?
it's crazy. It's crazy. I was reading a thing today where there are markets where 0 interest rates, people couldn't afford the homes because they're still so damn expensive.
I mean, I don't like, so, I mean, just think about it, right? If you're buying, I mean, there's a lot of places like here in this area. If you wanted to buy like in King County, out places where I live, like the traditional 2,800 square foot, 3,000 square foot house, half acre lot, that kind of deal, you're probably looking at 1 to 1.2 million.
Yeah.
Right. So that house that used to be, not even that long ago, 750 grand, $3,500 mortgage payment, even at 0%, you're looking at $55,000 to $6,000 a month.
Yeah.
And that doesn't even include homeowners.
Yeah. So it's how people do it. And it's such a bizarre world that we live in. Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. If unemployment ticks up, because let's be real, this is go time. Everybody makes hay. It's the fourth quarter. It's big time. This is Christmas time. Normally this time of year, you hear like Target, they added 75,000 gazillion jobs and blah, blah, blah. You're not hearing those kind of things that you've heard before.
Yeah. No, so it is clear right now that you're slowing. One of the things that we are noticing, though, is that unfortunately, and this is one of the things that makes us concerned about the Fed. So the analogy we use this week is that you're looking at a 21st century market and you're looking at it through a 19th century lens, meaning every metric that we look at, and in my opinion, I think you can even extrapolate that to GDP. the underlying conditions of the economy are so unique. There is nothing. I mean, if you want to go down to like go find a comp in history for where we currently are, where you're running 7% deficits, 130% debt to GDP, S&P 500 trading at 31 times earnings after going through a 15-year expansion with no proper recession. COVID does not count as a recession.
Yeah.
Right? Retail spending does not skyrocket in a typical recession. So we're not counting that. So when you look at how much of the economy is switched over to online, you look at how much faster that has driven things. Look at the upsurge in in single person LLCs. The economy is so different and it moves so rapidly now that when we're looking at this economic data, we don't know what we're looking at. And when I say we don't know what we're looking at, the best way to describe it is, like let's say we're in elementary school, right? And if I hear a bell go off at noon and I hear a bunch of doors open, a ton of kids go out, based on historical precedent, I could assume that it's probably lunchtime, right?
Yeah.
Right around noon. Okay. All of a sudden, we flip it around. We go to Sweden, right? Or somewhere at a completely different time slot or whatever. We're at a college as opposed to a high school, right? Change all those functions. It's probably silly for us to assume that if we hear a bell at noon and doors open, that it automatically means lunch. Not my best analogy I've ever made, but trying to explain like how one of the things that worries us the most is the Fed is so data dependent. And when the data is so skewed, meaning I could sit here all day long and sit there and go, look at this number, now counterbalance it with that. When was the last time you saw those two numbers pop up at the same time? I don't think anybody knows what they're looking at, including the Fed, and yet we're still making Fed policy on it. And so the one thing I will say is the chances that the Fed is right, and if anybody wants to know what I mean, just remember inflation being transitory, right? So very rarely when the data is this skewed or screwed up, very rarely has the Fed been right, period, let alone when the data is this muddy, right? So the chances that they're making the correct monetary policy aren't very good, right? Just looking at history, not dogging on the Fed. And because of that, especially when you look at valuations, when you look at the fact that the dollar dropping is a really big deal. It's not dropping to a point where people need to panic. But remember, one of the things that drove U.S. markets for the last 15 years was the dollar strength. Everybody forgets about this. If I'm an investor sitting over in Italy and I'm worried about my economy and I look over at the United States, the world reserve currency of the world that also happens to be home to the best companies in the world, and I'm sitting there watching the mess that my country is, I'm sitting there going, yeah, U.S. stocks might be expensive and they might pull back 20%. But if my currency pulls back 30% versus the dollar over the same period of time, yeah, my stock account just took a 20% hit, but net, I'm 10% up.
Yeah.
Right. So they really had no other choice as an international investor to be in U.S. markets. Now you look at the scenario and it's completely different. Meaning, if you price the S&P 500 in euro terms this year, it's negative. It's negative, right? So now all of a sudden, international investors, and this is one of the reasons we were pounding on the table at the beginning of this year, hey, you need to get more international exposure, is because now they're sitting there looking at U.S. markets that are trading at 31 times. A lot of their domestic markets are trading at a discount of like below 10 times earnings. And now the dollar looks like it's broken its uptrend. So now when U.S. markets drop, you're getting hammered on both sides, right? The currency is losing value to your home currency and your equity positions are getting hammered. The more that happens, the more outflows you're going to see on an international basis. And it's not a prediction. It has to happen.
Goodness, crazy, just crazy. Last question. Trump has hinted maybe we shouldn't have quarterly. Maybe we shouldn't look at this stuff on the quarterly basis and earn and this, that, and the other. There's a worry there. Okay, not every country does it. We have it built in a certain way that you have to do it that way. You can make a little argument one way, but at the other time, you're also asking investors, to invest money in a company that maybe be going sideways, and you won't find out about it until you get kicked in the shorts?
Yeah, that's a good question. So I in my opinion, to answer this question, we've got to do something that nobody seems willing to do these days, which is inject some nuance into it, right? So on the one side, I see exactly what they're attempting to do, and I don't disagree. Meaning, one of the concerns when you look at the stock market, it is unlike any other time that I'm aware of in history, the short-term thinking is just incredible. Okay. And so to try to encourage the market to be a little bit more long-term thinking or market participants to be more long-term thinking, I don't think is a bad idea. That being said, less transparency and less information to investors on a quarterly basis ain't the way to do it, in my opinion. And in markets have to do what markets have to do. Meaning, if people want to be idiots and spend too much money and push prices too high, that's what they're going to do. But I do not think, I cannot see any potential positives in having annual quarterly earnings releases. And that's not me begging on Trump. I just do not understand how that makes the economy better. I think that if people are overreacting to quarterly earnings, that's their fault. Right. If like, and part of me doesn't want to see that, because that's one of the ways that we've made a lot of money in this market is I see people overreact to quarterly earnings. It creates a buying opportunity for us and we step in. But I do not know of a single scenario, and there's probably one because I feel like every rule has an exception, but what system, right? And the US economy and markets is one of the most complex systems on the face of the earth. What system gets better due to a lack of transparency or a reduction of transparency? I just don't understand that narrative whatsoever.
No.
But chalk it right up to, that's another curveball we've gotten out of them the other day. I sat there and listened to Pam Bondi talk about hate speech, and I about fell out of my chair. So there's a lot going on that I'm not really understanding.
The worst too. Have you seen that podcast? That's a Stephen Miller's wife.
Oh,
I watched it and I said to myself, it felt like that between two ferns. Like, I feel like
it couldn't have been that good.
It was, she was awful. Pam Bondi's already awful. And I'm watching it and I'm thinking to myself, it feels like everybody that's watching is in on the joke and the people aren't in on the joke that are on the screen.
Yeah. The only positive thing you could say about it is that they didn't pull the Gavin Newsom. What is that? That guy is so good at being sleazy, but like you would think that like his people would sit there and go, dude, you got to be less sleazy. Like you just come off as a used car sale. I don't you feel like you're going to catch something
he
from
feels
the guy?
like one of those things where it's like, hey, dude, you want some Coke?
Just don't tell anybody. Don't tell anybody.
Yeah, don't tell anybody where you got it. Zach Abraham, Chief Investment Officer. Tell everybody how they get a hold of you. And October 2nd, you got your webinar.
Yeah, bulwarkcapitalmanagement.com, or you can search knowyourriskpodcast.com. Do our podcast every single day, review anything pertinent that's happening in the world of economics, finance. Do our hourly show every Friday with interviews. Had a couple bangers recently. Matter of fact, I got to pull up. Stephen Mirren keeps getting more run. Trump's guy. We've had him on the show twice. But I'll put those episodes back up. He encourages me. He's actually a very smart human being. But yeah, follow us on Twitter, knowyourriskpodcast.com, Google it, search it on YouTube. We're not hard to find.
Right on, brother. You have a good week. We'll do it again next week.
All right. Thanks a lot, man.